In this video I will talk about frequent mistakes made by traders, especially new traders. Keep in mind these are my observations, and they are just my opinion. Nonetheless, here is what I am going to discuss. Why does it happen? No strategy. Lot size. Not protecting your trades. Not understanding liquidation. Over-leveraging. Bad avoidable trades. Lastly, I will finish off with a summary. Here is why I think there are so many traders making bad trades, but let me know what you think. Nowadays many people want to make money from home. That is when they discover trading. And from personal experience, after watching a couple of trading videos, my YouTube recommended is filled with fake Forex traders on their MetaTrader app, plugging their signals group. The worst thing is my YouTube stories section, in which a person shows his crazy P&L and 100 open trades. So to sum up, new traders don't find good educational content, instead they end up seeing Forex scammers, and some lose money. Mistake number 1. One of the most common mistakes people make is not having a strategy, or a self-tested strategy. Some traders think they can perfectly predict the market just by looking at a candlestick cheat sheet image. It is not only important to have a strategy, it is crucial to have tested it yourself. Moreover, after demo trading and testing a strategy for weeks, if you are not profitable, you are likely not to be profitable in the real market. Mistake number 2. People make a large position size trade. A good rule of thumb is a few percent, up to 5% of your total equity. However, many new traders will go in with 50% of their equity in a single trade. Moreover, when you combine that with high leverage, it is a recipe for a disaster. A good habit/exercise for new traders is, if you feel anxious about any of your open trades, you should probably close it, because it is likely you didn't follow your own strategy. If you do this, you may lose money throughout the discipline enforcing training, but you will prevent a terrible habit and probably account liquidation. Mistake number 3. Let's talk more about risk management. It is important to protect your position at all costs. Many new traders don't place stop losses, and when you make a bad trade, and you don't set a stop loss, your trade might get liquidated. There are many different ways of getting out of trades. The simplest is of course a stop loss that closes the entire trade. You can also scale out and be in the trade as long as possible by closing a small portion of your trade after a determined amount of pips or whatever scaling strategy you have. Another good way to get out of a trade is by using a trailing stop loss and letting the trade make you as much money as possible. I mentioned liquidation before, but what does it mean? Usually when you trade a market, whether it is Forex, stocks, crypto, or other leveraged products, you trade on margin or leverage. Leverage is a loan from your broker. This boosts your equity so that you can open a bigger size trade. Leverage varies from market to market and then broker to broker. But the leverage on Forex is usually between 30 to 500 depending on the regulation. So, for the broker to not lose money, they can liquidate your trade if you have insufficient funds to maintain a trade. Mistake number 4. Let's have an example. If you have a $200 account and opened a trade equaling $100, if your margin level reaches 20%, in other words a floating P&L of negative $160, then the trade will be closed because you are close to reaching a level where you can't maintain the position. So the easiest way to understand margin call levels or stop out levels is by dividing equity with used margin. In this case 40 divided by 200 equals 20%, so your trade would be closed. This is an account liquidation because the broker uses your equity to maintain this trade as it is falling. Crypto trading platforms have an option for isolated margin. In that case she would only have to reach 100% margin level or all the used funds to get liquidated. So with our previous example, she would get liquidated when she reached a P&L of negative $100 because that's technically all the margin equity she has for that trade. The thing with leverage isn't whether higher leverage is worse or not, but how the person uses it. Time for an example. Take two people. Tom's broker offers a leverage of 100 times. Peter's broker offers a leverage of 1,000 times. Now let's see what happens if they both open a $100 trade. Tom can get into a position of 0.1 lot. Peter, on the other hand, can make a 1 lot trade. Now Tom's trade is safer, and for every pip the market move, he either makes or loses $1. Peter, on the other hand, will either make or lose $10. The biggest mistake you can make if you have a high leverage account is using it to open a huge trade. If Peter had a $200 balance with a $100 worth trade, he would only have to lose 16 pips to get liquidated. On the other hand, Tom would have to lose 160 pips to get liquidated. So don't over-leverage. Mistake number 5. Some new traders make stupid trades. There are many stupid things a trader may do, but here are a few I could think of. The first type of dumb trade is blindly following someone else. This trader might be in a signal group, or your trading platform has auto-chartist, but this is not a valid reason for you to not think or do your own analysis. Another stupid thing I've seen people do is trading off of news. Now, there is nothing wrong with trading on news releases. Sometimes the news can indicate that you should close your position if the news isn't favorable. However, what some people do is they open a trade with almost 100% of their account equity and hope for a specific news outcome. This is the same as betting on company earnings with stock options. The last stupid types of trades people make is DCA. It stands for dollar cost averaging, which is adding more to your open position as it loses and hoping that it turns back around. The most common thing you will hear from people in the trading world is cut losses quick. DCA is being used stupidly by people that don't want to lose, so instead they add till they get liquidated. In the beginning, DCA might look cool because you have a high win percentage, and with DCA you are likely to stay in a trade until it turns profitable. However, what if it doesn't? That's when you get liquidated. Here is a summary of the things I said. Don't get inspired by a Forex trader who is bragging about his account and telling you to buy his course or signals. Don't trade without a strategy that you have tested and been profitable with in a demo account. Don't enter a trade with a huge position. Don't over-leverage, try sticking to 5% or less per trade. Don't forget to set a stop loss. You don't want to wake up to an email saying your account was liquidated. Don't try to get rich quick by making stupid gambling trades. If you can avoid these things, you can be a profitable trader.